All right, let's dive right in. Today, we are getting into the nitty-gritty of tax and reporting for litigation settlements. Now, if you're a legal or tax professional, you already know how incredibly important it is to get this stuff right. We're going to walk through the key code sections and regulations you absolutely have to know. So let's frame this whole discussion with a scenario you've probably seen a dozen times. A defendant pays out $300,000 to settle a case. Simple enough, right? But who gets a Form 1099? Is it the claimant, the attorney, both of them? And for how much money? You know, the answer is way more complicated than it looks, and making a mistake here can be costly. By the time we're done, you'll know exactly how to handle this. Okay, so here's our game plan. We're going to start with the absolute foundation, the presumption of taxability. Then we'll get into the most important exception, the physical injury exclusion. After that, we'll cover the mechanics of reporting payments to plaintiffs and then to attorneys, look at some real-world examples, and finish up with a look at qualified settlement funds. All right, Section 1, the presumption of taxability. This really gets to the heart of the matter. Why does the IRS's default position seem to be that every single dollar you receive is income? Well, it all goes back to Internal Revenue Code Section 61. This section's definition of gross income is incredibly broad. All income from whatever source derived. What this does is create a powerful legal presumption. Basically, the IRS's default setting is that's taxable, and the burden of proof is entirely on the taxpayer to find a specific written-in-the-law exclusion that says it isn't. So, how do you prove an exclusion applies? You have to use what the courts call the origin of the claim doctrine. And the idea here is simple but critical. You can't just write tax-free damages in the settlement agreement and call it a day. The IRS is going to look right past that document and ask one question. What was this lawsuit really about from the very beginning? Now, this isn't some new concept. It was established in landmark cases like United States versus Gilmore. It forces us as professionals to be detectives. We have to dig into the original complaint, the substance of the dispute. Was the plaintiff suing for lost wages? That has one tax result. Were they suing for a physical injury? That's a completely different tax result. The answer to that question dictates everything that follows. And that leads us perfectly into our next section, which is the big one you'll encounter most often. Section 2, the physical injury exclusion. We're going to dissect the single most critical exception in this area, IRC Section 104, A2. So let's look at the actual language from the code. It excludes damages received on account of personal physical injuries or physical sickness. The key phrase there is on account of. There must be a direct causal link from a physical harm to the money received. And you'll also notice that explicit carve-out, other than punitive damages, that's huge. Punitive damages are almost always taxable, period, even if the case involves a serious physical injury. Now, things got a lot clearer after a major amendment to the code back in 1996. This created a bright line test. If the origin of the claim is a physical injury, then any related damages, including for emotional distress, are generally excludable. But, and this is a big but, if the claim is only for emotional distress, the recovery is taxable. The law is also very clear that the physical symptoms of emotional distress, things like headaches, stomach issues, insomnia, they do not count as the underlying physical injury needed to get the exclusion. So what does the IRS actually count as a physical injury? Well, they look for something practical, observable bodily harm. We're talking about tangible evidence, things you can see and document, like bruises, cuts, or swelling. And what's fascinating is that establishing even a relatively minor but documented physical injury can be the gateway to making the entire related award, including the emotional distress part, completely tax-free. Okay, so we have a handle on taxability. Now let's switch gears to the paperwork, the reporting mechanics. Section 3, reporting payments to plaintiffs. This is all about which forms to use, like the 1099 MISC and W-2, when you're paying the actual claimant. The form you need to file is dictated entirely by that origin of the claim analysis. So for taxable damages like emotional distress or punitive damages, you'll issue a Form 1099 MISC and put the amount in Box 3, Other Income. If the settlement is for lost wages or back pay, well, that's treated just like wages. It goes on a Form W-2 with all the usual payroll taxes withheld. And here's the easy one. If the damages are excludable under Section 104 for a physical injury, you don't issue any information return to the plaintiff at all. Okay, now we get to the part that trips up so many people. Section 4, reporting payments to attorneys. You have to remember the reporting rules for the plaintiff's attorney are completely separate, governed by a different part of the code.
We're talking about the critical distinction between Section 6041 and Section 6045F.
Let's break this down with a table. You see, the taxable damages paid to the claimant fall under Section 6041, reported in Box 3 of the 1099 MISC. But the payment of gross proceeds to the attorney, that's the entire check amount, is governed by Section 6045F and gets reported in Box 10 of the 1099 MISC. And just to be crystal clear, this is totally different from paying your own lawyer for their services, which would go on a Form 1099 NEC. Now listen up, because this is a massive trap for the unwary. You know the general rule that you don't have to issue a 1099 for payments made to a corporation. Well, for this, you have to completely forget that rule. Section 6045F specifically eliminates the corporate exception for gross proceeds paid to attorneys. It does not matter if the law firm is a C-Corp or an S-Corp. If you pay them, you have to issue a 1099 MISC, reporting the gross proceeds in Box 10. Okay, enough with the theory. Let's make this practical. Section 5 is all about complex reporting scenarios. We're going to walk through a couple of examples directly from the Treasury regulations, so you can see exactly how these rules play out. So, let's go all the way back to that first question we started with. We have a $300,000 taxable settlement, and the defendant cuts a single check made payable jointly to both the employee and their attorney. And here is the answer. The regulations mandate what's called dual reporting. The payer must issue two separate forms 1099 MISC, both for the full $300,000. One goes to the attorney for $300K in Box 10 for gross proceeds. The other goes to the employee for $300K in Box 3 for other income. The IRS expects this, and their systems are designed to match these payments correctly to each taxpayer's return. Okay, now let's use the same scenario, but we'll change one critical fact. This time, that same $300,000 is for a personal physical injury, which means it's excludable from the claimant's income under Section 104. But the payment is still made with a single joint check. So how does this change the reporting? Take a look. The reporting requirement for the attorney under Section 6045F doesn't change at all. They still get a Form 1099 MISC for the full $300,000 in Box 10. But because the recovery is tax-free to the claimant, you are not required to file any information return for them. No 1099. This really shows how these two reporting obligations are completely independent of each other. Now, a question I always get is this. Okay, the attorney gets the joint check and a 1099. Do they then have to turn around and issue a 1099 to their client? And the answer is generally no. The Treasury regulations call this a Ministerial Act. The attorney is just a middleman, passing the funds through their trust account. The original reporting duty remains with the defendant, and having the attorney file another form would just create duplicate reporting. And finally, let's touch on a more advanced tool that you'll see in class actions and other big multi-party cases. Section 6, Qualified Settlement Funds, or QSFs. This is a special structure governed by IRC Section 468B. You know, a QSF completely changes the reporting flow. The defendant makes a payment into the fund, which is treated as a payment to a corporation. This means the defendant is generally off the hook for issuing 1099s to all the individual plaintiffs. Instead, the reporting responsibility completely shifts. The QSF administrator becomes the new payor, and they are responsible for issuing all the necessary 1099s and W-2s when the money is finally distributed to the claimants. So we're going to end where we began, with a question that every single practitioner should ask on every case. The settlement agreement is signed, the case is over, but is it IRS proof? Because getting that signature only ends the litigation. It's the beginning of the tax compliance journey. Is your allocation truly based on the origin of the claim? Are the reporting duties clearly understood by everyone? Making sure your settlement can withstand IRS scrutiny requires every bit as much diligence as winning the case itself.